Okay, class, welcome back. And today we're going to start section 5 of chapter 8. And today we're going to talk about annuities, methods of savings, and investments. Okay, and so this is going to be the more complicated formulas, and this is going to be, again, something that you're going to want to spend a lot of time making sure that you understand and know the formulas. Okay, so we're going to learn how to determine the value of an annuity, in fact, what an annuity is. We're also going to learn how to determine regular annuity payments needed to achieve a financial goal. We're also going to learn how to understand stocks and bonds as investments. We're also going to learn how to read a stock table, and then also how to understand accounts designed for retirement savings. Okay, so now, an annuity is a sequence of equal payments made at equal times. So that can cover many different investments, but an annuity in the general case is just a sequence of equal payments made at equal time periods. So the value of annuity is the sum of all of the deposits plus all of the interest paid. That's going to be the value of the annuity. Now, let's say you deposit $1,000 into a savings plan at the end of each year for 3 years. The interest rate is 8% per year compounded annually. Okay, now we want to find the value of the annuity after 3 years. Okay, so we were going to do this after each year. Okay, so to find the value of the annuity after 3 years, we're going to have to find the interest compounded annually after 3 years. Okay, so now, and then we're going to find the interest. So the way we do this is to find the value after 3 years, it's going to be the sum of all of the deposits made plus all of the interest paid over the 3 years. So the value at the end of the first year is going to be $1,000. Okay. Then the value at the end of the second year is going to be the $1,000 plus the $1,000 again, plus the 8% of the $1,000. So it's going to be this, right? So it's this amount here, okay, which is going to give you $1,080. So you have a total of $2,080, okay? And then at the end of the third year, you're going to have, again, $1,000 deposited plus 8% of the money that's there. Now you're depositing, so let's go back. So make sure you understand this. You're depositing $1,000 into a savings plan at the end of each year. So at the end of the first year, you deposit $1,000. You haven't accumulated any interest. Then at the end of the second year, well, you've earned 8% interest on the $1,000 that you invested here, plus you deposited another $1,000, right? So then now your value of your annuity is the $1,080 you have in there at the end of the second year, plus the deposit that you just made at the end of the second year, so $2,080. Then at the end of the third year and final year, you're earning 8% off of the $2,080 plus the $2,080. And then you're adding another $1,000. So the value of your annuity at the end of the third year is $3,246.40. So that's the value of the annuity at the end of 3 years. Now, since you made 3 deposits of $1,000, that is not included in your interest. So you have to subtract that off. So you have to subtract off $3,000. So the amount of interest that you earned on this annuity is $246.40. Now, instead of doing it step by step, you don't want to do this for, let's say, 30 years. If you have a problem that says, hey, let's say I'm doing $1,000 at the end of each year for 30 years. You don't want to keep doing that. So here is the future value formula that's used for an annuity or any type of account where you're making regular deposits at regular time intervals. Okay, so if P is a deposit made at the end of each year for an annuity that pays an annual interest rate of R, which again is in decimals, you're going to put it in decimal form, compounded once a year. The value A of the annuity is this. Okay, so this is the formula. Okay, so it's going to be P times this whole thing, 1 plus R to the T minus 1 over R. Okay, now what if, I'm just saying, what if it's not annual compounding? What if it's compounded monthly? What happens to this formula? Well, guess what? Very similar to the last time. You're going to divide R by N, you're going to multiply T by N, and you're going to have R divided by N down here. And so, as you're going to see, you get a general formula. So just keep that in mind. But this is the formula if it's compounded annually. So to save for retirement, you decide to deposit $1,000 into an IRA at the end of each year for the next 30 years. If you can count on an interest rate of 10% per year annually, how much will you have in the IRA after 30 years? And then find the interest. Again, so to find the interest is we're basically going to subtract what? $30,000 off of our whatever answer we get for part A. So how do we do part A? Well, we're going to use that formula. So what we're going to do is we're going to take this formula and we're going to plug in the principal. The principal is the regular payments. So this is actually payments, right? P here represents the regular payments, not principal. So your payment is going to be 1,000. Okay. R is 10%, so it's going to be 0.1. T is 30 years minus 1, and then again divided by 0.1. And so all you're going to do is put this in your calculator and solve. And so when you solve this, you get $164,494, rounded to the nearest dollar. Okay, so that's the amount of money you're going to have at the end of 30 years. Now, how much interest did you make? Well, you paid $3,000 at the end of each year for 30 years, so that's going to be $30,000. So you're going to subtract $30,000 from this. So you actually made in interest $134,494. And so the interest is nearly 4.5 times the amount of your payments. And that is the magic of compound interest. So now, here is the general formula. So look, this includes all compounding. Okay? So again, N, now be careful. N in this case is the number of payments per year. Okay? Now, and the only reason this works is we're assuming that the payment schedule is the same as the number of compounding. If it's not, this formula does not work. So notice that the compounding period, so P is made at the end of each compounding period. So if this is the number of compounds, we're assuming the payments are made on a regular basis in the same time period. Okay, so if this is monthly, then you're making regular monthly payments. If this is weekly, then we're assuming weekly regular payments. Okay, so just keep that in mind. That's the only way this formula works. Okay, is with that assumption. Okay, so this is the formula that we're going to use. So let's say that at the age of 25, to save for retirement, you decide to deposit $200 into an IRA at the end of each month at an interest rate of 7.5% compounded monthly. It says, how much will you have in your IRA when you retire at age 65? Okay, and then we're going to find the interest. Okay, so we're going to use the general formula to find our future value. So we're going to use this formula, and we're just going to plug in all the values. Okay, the regular payments is 200. Our interest rate is 0.075. Our number of compounds per year is 12. So that's where this goes. And we're at, how old are we? We're 25, and we're going to 65. So that's 40 years. So that's where the 40 comes from. And so again, we know where this comes from. That's the same as this. And then we're going to just put this in our calculator and plug and chug. So just, again, make sure you get these correct, okay? And so we end up with approximately $604,765,000 at the end of 40 years, just by depositing $200 a month in a interest-bearing IRA at a 7.5% interest rate. Now, how much of that is interest? Well, we got to figure out what your total payments were. So for 40 years, you made $200. You invested $200 a month. You deposited $200 a month. So how much is that per year? Okay, that's $2,400 per year over 40 years. And so we got to find out what that payment is. So that means 200 times 12 times 40, which is 96,000. So we subtract that 96,000 from here, and so guess what? You made $508,765 in interest. That is the power of compound interest. Okay. Okay, now planning for the future with an annuity. So here's the thing. The deposit, which is, or your regular payments, P, that must be made at the end of each compounding period in an annuity that pays an annual interest rate R, compounded n times per year in order to achieve a particular goal, which is A, right? All you do is you take your formula. So this is messed up here. This is not correct. So I'm just going to go back to the formula. All you're doing is taking this formula and solving for P. So if you have a goal, let's say you want to have $1 million for retirement, and you want to find out at, let's say, a 10% interest rate, compounded daily, or excuse me, monthly, how much money would you have to put away monthly basis to reach your goal? Well, all you do is solve this formula for P. So all you're going to do is multiply by the reciprocal of this thing right here. Okay, so all you're going to do is multiply by the flip of this thing, the reciprocal of this thing. So you're going to get A times R over N divided by this whole thing. Okay, so you're going to get A times R over N divided by this here. Okay, so let's say once you complete college, your college education, begin working, you would like to save $20,000 over 5 years to use as a down payment on your home, which is not a bad idea. You anticipate making regular end-of-the-month deposits into an annuity that pays 6% compounded monthly. So the question is, how much should you deposit each month to reach your goal? Okay, so the goal is what? You want $20,000 after 5 years. So we're going to use that formula. And then it says how much of the down payment is going to come from the deposits and how much is going to come from interest. So we're going to use this formula. So again, all we did was solve the general future value formula for P. And then all you're going to do is plug in the values. So A is 20,000, R is 0.06, N is 12. And so all you do, and T is 5 years. And then you figure out your payment. So all you have to do is put away $287 every month for the next 5 years at a monthly compounding rate of 6%, and you'll have $20,000. Now, how much of that $20,000 came from the payments, the regular payments, and how much came from the interest? Well, total deposits are going to be what? $287 per month. So that's times 12 for 5 years. So you're going to end up paying $17,220 of regular payments, and the rest, so $2,780 will come from interest, which is not bad for 5 years. Okay? Okay, now let's talk about investments. Now, when you deposit money into a bank account, you are making a cash investment. Checking accounts, savings accounts, money market accounts, those are cash investments into a bank. The account's interest rate guarantees a certain percent increase in your investment called a return. Okay. Now there are other kinds of investments that are riskier, are called stocks and bonds. Now, investors purchase stock, and stock is ownership in a company. They're shares. Okay. So when you buy a stock share, you're buying a piece of ownership, a piece of the company. Okay. So for example, if a company has issued a total of 1 million shares and an investor owns 20,000 of those shares, then he is a 2% owner in the company. He has a 2% stock in the company. Okay. Now, so any investor who owns some percentage of the company is called a shareholder. And if you own enough shares in the company, you can actually be invited to the board meeting, the shareholders meeting every year. Now, buying or selling stocks is referred to as trading. Stocks are traded on what's called a stock exchange. Okay. So now there are only two ways to make money by investing stocks. You either sell your shares for more money than what you paid for them, and this is what we call a capital gain on a sale of a stock. And be careful, because if you sell the stock, you'll have to pay what's called capital gains tax, which you want to avoid, but sometimes it's unavoidable. The other way you make money in stocks is sometimes, or a lot of times, if the company is very profitable, they will declare a dividend. And so what they end up doing is they take part of its profits for that year and they share it with the shareholders as dividends. And what you can do is you can take those dividends and as cash or as a payment, again, you'll have to pay taxes on those, or you can take those dividends and reinvest them into the company. Now, the other type of investment that's common is bonds. Now, in order to raise money and to dilute the ownership of the current stockholders, companies will sell bonds. So people who buy a bond are, what they're doing is they're lending their money to the company from which they buy the bond for. So basically the company's borrowing your money for a particular time period, and they're guaranteeing, or they're saying, we're going to pay you this amount of interest over that time. Now, bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased, called the face value, along with interest payments at a given date. Okay, now those interest payments are not compound interest. Those are going to be simple interest rates. Okay. Now, a listing of all of the investments that a person holds is called a financial portfolio. So if you start investing, then you can have what's called a portfolio, where it shows all of the different sectors of where your money is being invested. So you can invest some money in stocks, some money in bonds, some money in real estate, some money in all kinds of things. Okay. Commodities, which is another type of investment. Okay. So now most financial advisors recommend a portfolio with a mixture of low risk and high risk investments, called a diversified portfolio. And that is the most common thing to do, is you want to be diversified, because you want to basically protect yourself from a lot of high risky investments. But again, it depends on your risk tolerance. Now, reading stock tables. Okay, so here are the main common things that you will see in a stock table, and you'll see an example of this. So daily newspapers or online services will give you current stock prices and other information about stocks. So here are some of the common things you'll see. You'll see the 52-week high. And this refers to the highest price that the company stock was trading at during the last rolling 52 weeks. And then, of course, the 52-week low refers to the lowest price that the stock price was over the last 52 weeks. And then the stock refers to the company name. The SIM, which is the symbol, is the trading symbol, okay, that you'll notice. Refers to dividends, whether it's paid or not last year, if stockholders were paid a dividend. If they were paid a dividend, you'll see a percentage or a number there. If it wasn't paid, then it'll usually just be a dash. Then you got percent yield. This stands, well, percent yield. This represents volume. This is the hundreds of the sales volume in hundreds for that day or the past day. Okay, so the volume in hundreds stands for the sales volume in hundreds for the previous day. High stands for the highest price the company's stock traded the day before, yesterday. Low stands for the lowest price that the company stock was trading at yesterday. Close stands for the price at which the shares traded at when the stock exchange closed yesterday. Net change stands for the net change in the stock price between what it closed at and what it started at, what it opened at, okay? And then there's PE, which is the PE ratio or the price to earnings ratio. PE ratio is the ratio of yesterday's closing price per share divided by the annual earnings per year. Now, the annual earnings per year is not going to be found on the stock table, okay? But it will give you the PE ratio, and it'll be PE. Okay, now use the stock table for Disney to answer the following questions. Okay, so it says, what were the high and low prices for the past 52 weeks? If you owned 3,000 shares of Disney stock last year, what dividend did you receive? What is the annual return for dividends alone? How does this company compare to a bank account offering 3.5% interest rate? How many shares of Disney stock were traded yesterday? And what were the high and low prices for Disney shares yesterday? And then what was the price at Disney shares traded when the stock exchange closed yesterday? And then what does the ellipsis in the net change column mean? And then finally, to compute Disney's annual earnings per year using the PE ratio. This basically yesterday's closing price divided by the PE ratio. Okay, so now I told you, you're not going to find this on the table, but you can calculate it using the formula, okay, just by solving for annual earnings per share, because this is going to be on the table and this is given to you on the table. So let's go back. So what were the high and low prices for the past 52 weeks for Disney stock? Well, here it is. So here's the 52-week high. That's $42.38. The low was $22.50. Here's the stock name, Disney. Here's the symbol on the New York Stock Exchange, DIS. Here's the dividend, 0.21. So let's talk about that. Okay, so here we look under the heading dividend for the dividend paid per share. This is the dividend paid per share, so that's 21 cents per share. So you have 3,000 shares, so you just made $630. Okay, that's how it works. Okay, now under the yielding percent yield, this is the percent yield for your dividends if you are just basing it on dividends alone. And so for this, it's 0.6%. Okay, so this is much lower than what the bank would pay at 3.5%. But again, you don't just make money off of dividends. Keep in mind, you're making money off of the fact that this stock you're hoping is going to go up in value. Okay. So now under the volumes in hundreds, D says, what's D? D says how many shares of Disney were traded yesterday? Well, that's under volume. So under the volume, this is hundreds. This is what? Now this is 100, so we have to add 2 more zeros at the end of this. Okay, so this would be 11,590,000 shares were traded yesterday. Okay, so to find the number of shares that were traded yesterday, you take this number and add 2 zeros at the end because this is in hundreds. Okay, what else? What were the high and low prices for shares yesterday? Well, here's the high and low right here. So yesterday, the highest price that it was trading as $32.50. The lowest price was $31.25. And it closed at $32.50. And let's see here. What was the stock price? Oh, that was the close, $32.50. What does the ellipse mean? The net change? That means that it didn't change. It stayed the same. Okay, it means that there was no change in the stock price in the Disney stock. It stayed the same. Okay, so it opened and closed at the same amount. Okay, then H says we use the formula again with 43. So the PE, where's PE? 43. So that's the PE 43 and the close, which is 32.50. Okay, so we're going to use these two numbers to find the annual what? The annual earnings per share. So we find the yesterday's closing price and we divide by the PE ratio. Okay, and so we take 32.50 divided by 43, and the annual earnings per share is about 76 cents. Okay, thus the annual earnings per share is 76 cents. So the PE ratio tells us that yesterday's closing price is 43 times the earnings per share, which is not bad. Okay, now you can use regular savings and investment accounts to save for retirement. There are also a variety of other accounts that are designed specifically for retirement savings. We have what's called an IRA, which is a traditional individual retirement account. It is a savings account plan that allows you to set aside money for retirement up to $5,500 per year, okay, for people that are under 50, and $6,500 per year for people that are 50 or older. You do not pay taxes on the money that you deposit into the IRA. You can start withdrawing from the IRA at 59.5 years old. The withdrawals are taxed, okay? The withdrawals are taxed. Now, you can also do a Roth IRA, which means that you're going to put in after-tax dollars. So now there's the old saying of you either can pay taxes on the seed or you can pay taxes at harvest. And so if you don't pay taxes on the money that you're investing, then you're gonna Uncle Sam is gonna want their money. So when you take it out at harvest, when you go to retire, they're going to hit you with taxes on the amount that it grew. Okay. But Roth IRAs, you put in after-tax dollars, so you pay taxes on the seed, and then what happens is you're able to have that money grow, and some of that money is going to be, you don't have to pay taxes on it. But again, make sure you talk to a licensed professional for more information. Okay, so here, Roth IRA is a type of IRA that's slightly different tax benefits. You pay taxes on the money you deposit into the IRA, but then you can withdraw your earnings tax-free when you are 59.5 years although your contributions are not tax deductible, right, your earnings are never taxed even after withdrawal, which is a great advantage because you don't get taxed on your harvest. And I would rather pay taxes on the seed than to pay taxes on the harvest. Wouldn't you? Don't you agree with that? Now, there's also employer-sponsored retirement plans, 401k, which is for most employees. Employers will give 401k, or 403bs, which are for teachers. Okay, 403b plans are set up by the employer, often make some contribution in the plan on your behalf. Now, for example, it's called a company match program. Okay, now that means that for, let's say, for every dollar you invest, the company's going to invest up to a dollar for dollar up to, let's say, 5% of your check or something like that. Okay, not all companies do this, but most do. Okay, now these plans are not offered by all employers and are not used and are used to attract high quality employees. So this would be part of your, let's say, your benefit package, possibly. Okay, or they do this to attract people to come to their company. Okay. Now, word to the wise, personally, I would only invest up to the maximum amount that the company is willing to match. Anything over that, there are other investments I think that are better. Okay, but if the company is willing to match you 100%, that's free money. So take it. Okay, so that's the end of the section. Again, if you have any questions, let me know. Please go through this information more than one time, review this information, and again, come to class with lots of questions. We're going to do lots of examples. We're going to work on this stuff. And again, it's really, really about exposing yourself and practicing with this stuff so that you know it. Because again, this is something that will show up on quizzes and exams. So again, until then, keep plugging away at it, and I'll see you in class.